This is Agriculture Today, and I'm Samantha Bennett with the K-State Radio Network. We're beginning this Tuesday's programming with K-State agricultural economist Reid and agricultural policy specialist Jenny Ifft. They're joining us for a two-part conversation, where in part one, Robin focuses on highlighting ARC-PLC programming and all that the two financial protection programs offer. With the March 15th deadline fast approaching, Robin shares everything that a producer should consider when deciding to sign up. In part two, Jenny highlights high coverage options such as ECO and SCO. Jenny shares that these crop insurance options are a little more expensive up front, but have far larger payoffs in the end. We end with this week's Milk Lines, where K-State dairy specialist Mike Brouk takes a closer look at how Kansas dairy farmers impact local economies through employment, operating costs, and growth. That and more is coming up ahead on Agriculture Today. This is Agriculture Today. We are joined now by two guests in the studio. We have with us Reid. She's our K-State agricultural economist, as well as Jenny Ifft. She is a K-State agricultural policy specialist. And they're joining us today for a conversation on managing risk using some tools that we have available to us here in Kansas. So thanks for joining me today.
Thanks for having us, Samantha.
Absolutely. So, Robin, we're going to start with you talking through some ARC-PLC programming and some upcoming deadlines that producers should be aware of.
Yeah, so this is not a new decision for producers in the 2018 Farm Bill. We've been making this decision. This will actually be the fourth time now, and it's the final decision of the 2018 Farm Bill as we're looking at hopefully a new Farm Bill coming out this September or an extension of the one we have if we don't get that done in time. But really, this is, the last decision period of this 2018 Farm Bill. And just to kind of refresh the programs that we're looking at, I know a lot of producers are familiar at this point, but we're looking at ARC, agricultural risk coverage, and PLC, price loss coverage. So we're deciding between those programs by March 15th of this year.
So when producers are thinking about considering this, a tool in their toolbox that they want to take advantage of, what are some of the considerations they should be considering?
So the biggest thing, and I guess put it out there plainly, the reality of these two programs right now, with the prices that we're seeing, the higher commodity prices, neither of these programs will likely trigger unless we have a significant yield loss at the county level, or if you do the individual product, the individual level. Because of how these programs are set as far as what prices are setting the guarantees, those are so low right now compared to the commodity prices we have. It just takes a super big loss to trigger a payment. So let me start out talking in general about price loss coverage. This is the program that we're looking at the national marketing average price compared to a set benchmark. And so for wheat, that's $5.50, corn $3.70, sorghum $3.95, and soybeans $8.40. If you think about any of those prices now compared to where our commodity markets are, that is an extremely low price. What I do like to remind people is this marketing year doesn't actually start until next fall for corn, soybeans, and grain sorghum. So it starts September 1st, and it will run through August 31st of 2024. So there is a lot of uncertainty yet in what our prices will be over that time period. If we're talking about wheat, that marketing year starts June 1st of this year and will run through May 31st of next year. So when I talk about those PLC prices, yes, they seem extremely low. All of the predictions that we have right now are well above those prices. But as we know, it's a global ag economy, and there are definitely things that come out of left field that could affect our prices when we're talking a year and a half out. Likelihood pretty low, but there is a chance. So that PLC really provides that extreme downward price protection if we had a catastrophic event that our commodity prices would fall that far.
Sure. So for the ARC programming, how does that really differ from what we just heard about the PLC program?
The difference in the ARC program is that guarantee, instead of being a set price, is set by looking at the last 5 years of the marketing year average national price and the last 5 years of the county yield, and that sets a revenue guarantee. So each county has its own revenue guarantee based on its own county yields and that national marketing price. And that is for each commodity And also a lot of our counties have a split irrigated and dry land guarantee. So it just provides a lot more revenue coverage. But when you think about the formula in that, looking at the last 5 years of marking your average prices, it's an Olympic average, so it drops the high and the low, which unfortunately drops one of our high-priced years out of that average. And so the 3 years that get averaged into the price guarantee is very low. I have the numbers in front of me here. I know on radio it's hard to see, but pretty much if we're going to trigger an ARC County payment, we have to have close to a 50% yield loss based on the prices that we're projecting right now. Now, I know we're making this decision for the crop we're putting in the ground and harvesting this year. But if you think back to last year, the ARC County program probably is going to trigger because of the widespread drought that we had last year. So again, this is always hard to remember these different dates, but the payment we'll get this October was for last year's harvested crop. So I anticipate a lot of ARC County payments made this October because we had such a bad drought last year, and we have seen some of these 50% yield losses at the county level. What's going to happen here in 2023? We're still at a very large drought status across the state. So I would not be surprised if we do have some yield issues, and this ARC County program could trigger in some of our counties again with this year's harvested crop. End of the day, we sure hope it doesn't. We really hope that neither one of these programs pay, because end of the day, that means something went terribly wrong right now with the guarantees that we have. But yeah, basically, when we're looking at these two programs, ARC County does seem like it's probably the better choice because of having that yield protection in there. I know we're going to talk to Jenny here in a minute, but the stipulation between these two programs is that if you want to use the supplemental coverage options on your crop insurance, then it affects your program choice in that you cannot use the ARC, the Agricultural Risk Coverage Program. So that is a little bit of a caveat when you're making this choice as to which program you pick based on your crop insurance decisions.
Absolutely, yeah. And either or scenario, you can't benefit from both, unfortunately. And then I know with some of these programs, you know, if they had a crystal ball, it might make them more comfortable to make these decisions. But especially, like you said, with us not knowing where we're going to end up drought-wise, condition-wise, when those things will start to improve. I know we have some hope for the spring and summer to come, but drought could still continue to persist, and this might be a way to help mitigate some of the risk with that.
Absolutely. And I can give you just kind of some past history of what producers signed up for. You know, I know what your neighbor did doesn't always mean that's what you should do kind of thing. But as we've looked at the election of these two programs in the 2018 Farm Bill, we used to have a lot of grain, sorghum, and wheat base that were in PLC, and they had fairly large payments. As we've had higher commodity prices, a lot of our wheat and grain sorghum base is switching over to ARC County because the higher likelihood of payments in that program. So last year we had about 50% of our base in ARC County and 50% in PLC for those two commodities. When we look at soybeans, we have actually never had a PLC payment in soybeans. And if you remember, we've had some pretty bad things hit the soybean market, trade war with China being the number one thing. But even then, we did not kick in PLC payments. So ARC County has always been the preferred program for soybeans. With corn, I started out being a little more favorable in the PLC program, but again, as commodity prices have increased, last year we had about 65% of our corn base in Kansas going with the ARC County program instead of PLC. And I should mention, when you're making these program decisions, it is on the commodity base that is assigned to your farm. A lot of our farms may be growing corn and soybean, but still have grain, sorghum, and wheat base. And remember, it's the base that you're assigned to is what these programs will be based upon. So just keeping that in mind as you're signing up for the programs as well.
Absolutely. Yeah, some great insight there, Robin, on ARC-PLC programming. And of course, again, that deadline is fast approaching. It's coming up March 15th. So producers, be sure to be cognizant of this as you go about making your decisions for the year ahead.
Yeah, and I would even add on to that. In the past, we a lot of times wanted to wait till that March 15th. So we have all the information possible to make the decision. There is really no advantage to waiting. I would make an appointment with your FSA office if you haven't already. Go ahead and get signed up with a program. Like I said, it's so far out that we're going to know these market year average prices and our yields that there's no advantage doing it now or doing it on March 15th. If you made the decision and then something changed your mind, you could always change it again before that deadline. But go in now and get signed up, as I know our FSA offices are quite overwhelmed with a lot of different programs right now.
Nothing's going to change that drastically between now and March 15th. It'd be a miracle if the drought was resolved, but I don't foresee that happening.
Yeah, even if we got a ton of rain, I'm not sure the decision will be that much different between now and March 15th.
Absolutely. Well, Robin, thanks so much for that update on those important programs for our producers across Kansas. And we're cutting to a short break now, but when we return, we'll be back with Robin and Jenny, where they'll share more with us about ECO and SCO high coverage options. Jenny will share that these crop insurance options are a little bit more expensive up front, but they have far larger payoffs in the end, which makes them a good option for some producers. Before we cut to a short break, I just wanted to plug for another great event that is coming through K-State Research and Extension. KSRE will be hosting an online agronomy series called Crop Talk. It's slated to begin Tuesday, February 7th through Tuesday, February 28th, and will highlight several important topics for crop producers. These will be on Tuesdays, and each session will be held from noon to 1 p.m. Central Time. Planned topics of discussion include spring annual forages to fill the gap in cattle feed, climate-smart agriculture, alternative weed control research, and corn tillers, the good, the bad, and the ugly. You can register online now at www.northwest.ksu.edu/events/. Or you can call the Cottonwood Extension Office in Hayes. The number to reach them is 785-628-9430. Also, before we round out today's show, we'll hear from K-State dairy specialist Mike Brouk. In this week's Milk Lines, he'll share that the dairy industry in Kansas is a major economic driver for local communities, specifically highlighting the impact of employment, operating costs, and growth. That and more is coming up ahead on Agriculture Today. You're tuned back into Agriculture Today, where we're continuing our conversation on financial protection programs and coverage options for producers in Kansas. We'll continue our conversation now with Jenny Ifft. She's the agricultural policy specialist here at K-State, as well as Robin Reid. She serves as an agricultural economist. We're going to continue the conversation now, Jenny, with you. So we're going to talk through supplemental coverage options and enhanced coverage options as well. So these are high coverage policies, right? What does that really mean?
First of all, a supplemental coverage option, you can only do that if you don't have ARC coverage. And what that's going to do, it's going to take your underlying multi-peril policy, whether it's yield or revenue protection, up to an 86% coverage level, but any payouts on that higher coverage level are going to be based off of county level yields, not your own yields. The other high-level coverage policy, again, if you are looking at SCO, it does make sense to look at both of these at the same time. So the enhanced coverage option, that can be used with either PLC or ARC, so it is a little bit more flexible. And it's going to take a producer with an underlying revenue or yield policy from 86% to 90%, or from 86% to 95%. Again, there's the county level yield trigger.
So these are just options for a little bit of additional coverage if that's what producers are seeking after.
Right, exactly. And it's useful to think about these in context of why we do crop insurance in the first place, as well as the current market environment. If we look at the markets today, there's bad news and good news. The bad news is everybody knows that costs are really high, and that's painful. But the good news is prices are also still high, just like Robin talked about. And because of that, for the average producer, there is an opportunity to make a profit in 2023. If you go and look at our crop budgets, it looks like most row crops across the state are going to be profitable, again, at least for the average producer.
So when it comes to profitability, you said obviously there's a lot of disturbances going on in terms of input prices and then what we're expecting to see price-wise. Is that profitability actually guaranteed for producers this year?
No. It's based on current harvest prices or futures price, as well as average yields or the yields that we can expect. And as everyone knows, as we've been discussing, both can go down. And we've seen that happen a lot. So that's why most row crop producers do choose to purchase crop insurance. The most common policy is revenue protection policy. And in Kansas, folks are mostly using 70% or 75% coverage levels. So that, for the typical producer, say average cost levels, that 70 to 75%, based on the cost we're seeing this year, it's going to cover your direct expenses or your variable expenses. So that crop insurance policy, it's going to help you make sure you can cover your expenses, repay your operating loans. And that's important, but if a producer wants to go beyond that, so if you want to start, say, making sure you can, repay other loans, pay cash rents, protect some of that profit margin we're expecting this year, that's where you might be interested in looking into these high coverage policies.
Good to know for sure. And when producers are making considerations of opting for some of these programs, obviously we've talked about some of the conflicts for some of them. What other considerations should they keep in mind?
Yeah, and this is really a different decision than the one people are used to with their revenue or yield protection policies. And what's important to keep in mind, these policies, they cost more, but they pay out more. Your premium's probably going to double or more, but you're going to see more frequent payouts and larger payouts. And we have resources on AgManager.info about historic payments for Kansas counties. Some crop insurance agents also have tools to look at that. And the way this is designed, like most crop insurance policies, it is designed so the producer comes out ahead in the long run. But that long run part is really important because if a producer is using these policies, they could go a couple years without payments. This is insurance, so those are years where you're getting above your revenue guarantee, but still the premium cost can be painful in those cases, so it's good to have a long-term perspective. But yeah, another consideration is county level yield. So these policies are not triggered by what happens on your own farm, they're triggered by what happens in the county. So for some producers, if your fields are spread out across the county, you might be really close to that county average, or you just might happen to be close to that average. You also might be pretty far. If getting a loss or getting a payout when you have a loss on your own farm is important, you're going to want to understand that relationship. And so, again, you can talk to your crop insurance agent about this. And we have a tool for Kansas producers on AgManager.info. If you have your own yield history, you can go all the way back to 99. You don't have to. Whatever year you have it, you can go in and enter that, and it'll directly compare it to county yields and also show you a measure of the correlation or relationship. So how closely do your yields track county level yields? So the average doesn't have to be the same, but they have to move in the same direction. So I think most people I talk to say they have higher yields than the county level yields, and that's fine. It doesn't matter if you're higher or lower. It matters if you go up when the county goes up or down when the county goes down. And so we give producers a couple different ways of considering this.
Wonderful. So it's those trend lines you're looking for, not necessarily the exact number.
Exactly.
Good to know, Jenny. Thanks for that.
Yep.
When producers are tuning in and they're thinking about these policies in Kansas, are they specific for users or can anyone pretty much take part in them?
Anybody who has an underlying policy can use them. We've seen SCO grow since 2015, but both for SCO and ECO. They're still, for row crops, they're still under 5% of acres. You do have producers using them across the state. There are some regional patterns for corn, wheat, and sorghum. You see more producers using them in the western Kansas, more soybean producers in eastern Kansas, and to some degrees these follow production patterns, but they are being widely used. I would also say for crop insurance for 2022 and devastating droughts across most of the state, we're seeing that in crop insurance loss ratios. So the indemnities that people are receiving relative to the premiums they paid. And for the state as a whole, for corn and grain sorghum, the indemnities are around 4 times as much as producers paid into the program. And those indemnities can be really useful in managing the drought. So that goes to say that any producers who had ECO or SCO in 2020 are very likely to see, especially if they were in a drought area, very likely to receive large payouts or their full liability or full guarantee for those policies. That data is not available yet, and this is another important consideration. So producers that use ECO or SCO, indemnities aren't calculated until the USDA estimates county level yields. So it's going to be several months after you'd receive an indemnity for your underlying policy.
That is the unfortunate side of these programs, I guess, is the timeline aspect of them. Because especially in times of stress like this past year when producers are like, oh, my budget is tightening tighter and tighter, it seems like, as the months go by. I'm sure that is stressful.
Definitely. However, there's 2 reasons why having that county-based yield trigger is an important part of making these products available. First of all, it keeps the cost down. I know these products may seem expensive. They are going to increase your premium. However, if that guarantee was at the farm level, they would be much more expensive. There actually are some private products available as well that aren't subsidized where you can insure that farm level risk at higher levels. The second reason is something economists call moral hazard. And this is an issue for all types of insurance, whether it's cars or crops. And the idea here, what moral insurance basically means, if you insure everything, whether that's all of your crop or all of your car, some people might not take care of it. So again, whether it's driving safely or, make enough investments to get good crop yields. Now, I believe that most farmers are going to do the best for their farm no matter what. However, it could only take a few to cause problems for the entire program. And again, this isn't just a crop insurance issue. This is an insurance issue in general.
Sure, absolutely. And you mentioned AgManager being a resource and understanding these tools further. So when producers are accessing AgManager and they're going through that information, any advice on what they should input or not?
Yeah. So before I get into AgManager, I do want to emphasize, again, this is a different way of managing risk. There's more of an upfront investment. And I think it's important for a producer that's interested to sit down with their agent and really go through and make sure they understand all aspects. Again, we do have those tools on AgManager. So we have crop insurance maps where producers can look at historical payouts on average and also the annual likelihood for their county to get an idea of what that looks like. We have a tool where a producer can enter their own yields and see how they compare to county level yields. We also have a payout calculator. So a producer, and that's for this year. So a producer can use that and go in and see how far would these payouts go this year.
Some great resources for sure. And if listeners are tuning in and they're looking for more information in general when it comes to insurance or policy of this sort, I know this is a hard area for producers sometimes to wrap their head around. What are some of those resources they can really rely on during these times?
Yeah, I should mention, too, with the ARC-PLC decision under our ag policy section on AgManager, we also have a number of tools. A lot of those also are maps and interactive where you put your cursor over the county and you get the detail for that county. But out there, I have maps that show the county yields that would take to trigger an ARC County payment that'll be made in October this year, or trigger the maximum ARC County payment if the yield is below a certain threshold. So I have those. I have enrollment maps. You can look at your own county and see what producers have elected for ARC and PLC in their own county. And I also have a trade-off tool where, kind of like Jenny's, you can put in your own program yield for PLC, and you can look at the potential PLC payments versus the ARC County payments at different marketing or average price levels and different county yield levels. So those really help in making this decision as well.
Wonderful. Well, thank you both so much for joining us today. I'm sure if listeners have any questions, they can feel free to reach out to both of you as well, right?
Absolutely. You can find us both on agmanager.info under the Contributors tab.
Please feel free to reach out. I'd also add the yield correlation tool is brand new, so I would especially appreciate feedback, ideas for improvement for that.
Absolutely. Once again, everyone, that was K-State Agricultural Policy Specialist Jenny Ifft, as well as Robin Reid, a K-State agricultural economist, joining us for a conversation on managing risk utilizing ARC-PLC programming, as well as SCO and ECO high coverage policies. We'll be back with more ahead on Agriculture Today.
From Kansas State University, this is Agriculture Today over the K-State Radio Network. Along with Samantha Bennett, I'm Jeff Wickman. We end today's program with this week's milk lines. According to the Kansas Department of Agriculture, Kansas has consistently ranked as one of the fastest-growing dairy states. Kansas has established itself as a prime location in the U.S. for dairies, and milk production in the state has doubled since 1994. K-State dairy specialist Mike Brouk says that the dairy industry is also a major economic driving force for local communities. This week in Milk Lines, he takes a closer look at that impact.
Today I'd like to visit with our Kansas dairy producers and, others that might be listening about the importance of the dairy industry to the Kansas economy. It's kind of amazing what we've seen happen here at the state of Kansas over the last 25 years. We've seen our animal numbers more than double when it comes to dairy farms. Milk production here in Kansas has grown by almost 3x. We talk about those numbers and we talk about the comeback that the industry had made after losing a lot of farms and animals prior to that. But what does that mean to your community? As we look at the number of jobs, these would be direct jobs that are generated by the dairy cows that are in the state. Currently, it's about 8,500 jobs that are directly related to caring and feeding the animals every day, milking the animals, and moving the milk from the dairy farm to various processing plants and other things associated with what we actually do on the farm. When we look at it as an economic driver, so we sell a lot of raw milk here in this state, over $1 billion actually on an annual basis. There's also some indirect economic impacts that occur because of dairy production here in Kansas, and those add up to about $5.6 billion. So when you look at the impact of the dairy industry on a local community, it is really quite significant. I remember years ago we used to talk that for every dollar generated on a dairy farm, that dollar would circulate around the community about 7 times. And that probably is still true today. So when we look at the many things that the dairy industry does for the state, one of the big things is local economic development. And this is important for our schools. Many times, as we look at the employees of dairy farms, they many times have families, and those families usually have some children with them, and that impacts our local school systems. And in many of our communities out west, the dairy farm and those associated families with that dairy farm do contribute significantly to the number of students that we have in local schools. So when you look at the dairy industry moving forward, are we going to see some growth? Yes, we are. And that growth is going to be good for communities because it's going to provide families in the communities. It's going to provide for local economic development as well. One of the interesting things about dairy farms is that our dairy cows are going to have to consume a lot of feed to actually produce the milk that they do. And in fact, when we look at the value of feed to the dairy industry here in Kansas, dairy cows consume probably nearly $500 million worth of feed every year. So it is very, very significant as it drives other things in the community other than just the dairy farm. So when we think of dairy and we think of its impact on economic development within our state, it is really a very, very important part of what we do here in Kansas. And you as dairy farmers should take pride in that. You've done a great job of working within your communities to grow your dairy farms as well as to grow the economic development that stems from what you do every day. This is Mike Brouk with K-State Research and Extension, encouraging our dairy farms to think about the local impact that their farm has on local communities.
Thanks, Mike. That's K-State Dairy Specialist Mike Brouk with information on the dairy industry in the state being a major economic driver for local communities. And that'll do it for this edition of Agriculture Today. For Samantha Bennett, I'm Jeff Wickman. This is the K-State Radio Network.